Joining me now is Jonathan Hertz, the CEO of the Peregrine Group. Let's take a step back in terms of your career. You're an actuary. In 2000, you joined Peregrine. You then created a number of business entities, partnerships. 2006, again entered the Peregrine fold, and 2013 appointed as CEO of Peregrine. Obviously, there's some missing parts. Care to colour them in for me?
When I joined Peregrine, almost immediately after joining, I became the Chief Operating Officer of the group. And that was quite special for me because I got to understand the businesses in quite some detail. In those days, back in 2000, we had a plethora of operating subsidiaries. We had over 25 different businesses doing lots of different things. You'll remember in the early 2000s, that financial services companies sometimes traded at ridiculous multiples and did all sorts of different things. And people struggled with Peregrine because we had so many different businesses. So I became involved in many of them, and some of them we closed down, some of them we sold back to management. But we developed the company into 5 very strong subsidiaries, all of which are with us today. Brand names, people know them, things like Citadel, Peregrine Securities, our hedge fund business. Remember, we started hedge funds in South Africa back in 98. So these were very strong franchises, good businesses, and pretty much market leaders in what they did. In late 2005, I came up with an idea that I was very excited about. An offshore idea. In fact, I often tell the story. I went off to a big conference in 2006 in Philadelphia, one of these CFA conferences. I was running up and down the stairs like Rocky, raising my hands as one does in Philadelphia.
As one does, of course. As one does.
And I sat next to a Chilean hedge fund manager, and I looked at his fact sheet, basically showing how he's done in the world. And I thought the numbers were most average. I couldn't believe how bad they were. And yet he told me they were looking.
I thought you were going to say that the numbers shot the lights out.
No, they were terrible. But he had $200 million in assets, and the whole of the South African industry didn't have $200 million from foreigners investing in our industry in hedge funds. Yet our hedge funds were doing fantastically well. And I came back to South Africa and I decided, look, I'm going to build a business. I'm going to go to the biggest and best hedge fund managers in South Africa, and I'm going to build their offshore business. I'll walk the streets of London and New York and Paris, and I will launch their dollar classes of their funds. For so long, South Africans have kind of had the view that what happens offshore must be better than what happens here. But certainly on the numbers I'd been seeing, I thought that the South African funds had done fantastically well. And slowly I built that business. It's quite daunting walking up and down, the streets of London and
New
knocking
York
on
as
doors.
a South African.
As a South African, and telling people, listen, you shouldn't put all your money in these New York hedge funds or these London hedge funds or these Asian hedge funds. You should have a look at how we've done in this country. And
what was the response from the outset?
So initially, in 2007, the response was excellent. And then in 2008, they said, please never come back to see us again because we've lost all of our money in the global financial crisis.
Emerging markets out of favor.
No one wanted to touch them. But what was amazing was that our funds did very, very well in 2008. Very well.
Given the volatility.
Given the volatility and given how badly worldwide funds did, our funds did incredibly well. I mean, one of our best known funds that I won't mention was up 17% in dollars in 2008. It was pretty much unheard of, and then did well again in 9 and 10. And the business grew, and it was a great business. Started really in a room with 2 people, using some of the expertise that I developed from a Peregrine perspective. And still dealing with Peregrine, who of course run the biggest prime broking business in the country. So, many of them were my service providers. And then in late 2012, there was an opportunity to come back to Peregrine as the CEO. I must say I was a little reluctant at first. My little business, my baby had grown dramatically.
Were you happy to go back into a corporate fold? I mean, you were the boss, you had something entrepreneurial on the go.
Yeah.
Difficult decision?
It was a difficult decision. The beauty of the Peregrine Group, which makes it quite unusual versus other businesses of our kind, is we like our staff to own actual equity stakes in their businesses.
So they're shareholders in the business?
Absolutely. And I must tell you, it has huge advantages. I'm fast forwarding, but when we have a capital raise in our businesses as they grow, we make the management write out a check alongside us for their equity, and
they don't resist.
And they don't resist.
They're actually quite happy to do that.
Absolutely, because come year end, when our auditors are finished with us and we declare our dividends, these people are owners in their business, and they get those dividends. So it's a proper partnership from that kind of perspective.
Let's talk about your recent results. You released in June your full year results for that 12-month period. And your headline earnings per share up 2%, headline earnings up 6%. Given that it was a tough market environment, you were quoted as being relatively happy with the results.
Yes.
But there are some standout elements to the results, and that, of course, is the annuity income. 80% of your revenue is annuity, 60% of your profit, and then the 40% offshore component.
Yes.
I want to dwell on the annuity revenue because this is the beauty of asset management. Once you've got your cost base, you basically then build on that, and it really is a model that everyone should try and deploy in their businesses.
So a couple of things. Firstly, over the 3 years, from 2013 to 2016, we doubled our earnings. So we were quite happy with the consolidation year after we'd been through such dramatic growth, to be honest. And the market had looked after us. Our share price was up about 3 times. So, we'd done very nicely.
Not a shabby performance.
No, we'd done well. And we'd done well, though, in a time when markets had helped. We'd been through a big bull market. We always do well when markets help us. And
that's the nature of the business.
It's the nature of most asset management businesses. But you'll remember that up until March of 2016, that 12-month period that we reported on, markets weren't great, and they were particularly poor in January and February of 2016. So a lot of the asset managers and banks had come out and said, look, our proprietary returns weren't as good, things have been tougher. So for us to be able to hold on to the record earnings,
it was still an outperformance.
It was an outperformance, and we were at record earnings levels. So that was good for us, and that's been important. And one of my biggest goals in a business is we've always been a business that can earn lots of money in good times. The question is, can we raise our annuity earnings to the stage that when things aren't great, we still earn a lot of money? And this was the year where we could show that. It didn't matter that we told the market, look, we're getting better, we're getting better, we're getting better. They waited for a year when markets wouldn't have helped us to indeed prove that we
And how
hadn't
quickly
fallen
did you
over.
ramp up to that 80% annuity of revenue, 60% of profit?
We did it in a big way over the last 18 months before that. Businesses like our big hedge fund business used to manage 2.5, 3
Now
billion.
8 billion.
Now 8 billion. You obviously in a asset management business, you get paid based on your assets under management as well as based on performance. But what happens is when your assets grow by whatever 150% in that case, your annuity earnings grow with it. Of course, the performance in a tough environment hadn't been quite as good, but our overall profits didn't suffer because
of the annuity
we had
base.
agreed. Take a Citadel business.
Now at 44 billion.
44 billion from
terms
less
of
than
assets under
20
management.
from less than 20 2.5 years before that. So lots of growth.
So basically more than doubled in size as a Citadel in the 2-year period.
Absolutely. So asset management businesses, as you've said, they're fantastic. They don't require much capital. They don't require stock. They don't require debtors. There are no debtors. In fact, you have the money, you charge the fees. So the working capital in a business like ours is actually, we have a negative working capital requirement.
There are a lot of people who are green with envy right now.
No, but you have some negatives. The negatives are that you're somewhat market dependent, and when markets don't play ball, you can't earn as much money. So what we've deliberately done is we've built businesses that are pretty much counter-cyclical.
It gives you that diversification. You're not
Absolutely.
solely reliant on buoyant markets.
Agreed. Last year came along, markets were tougher. Our asset management businesses didn't do very badly, but didn't do unbelievably well. But we now have the second biggest stockbroking business in the entire country, the biggest derivative broking business. These are businesses that do incredibly well in volatile times. People want to protect their portfolios, they trade more. And we saw some of the opposition who are purely in asset management. They struggled in times of markets being under pressure. We would never normally struggle quite as much because we're very big in the hedge fund space that doesn't have the excuse of saying markets are down, we can't earn money. In fact, their very promise to their investors is that we'll earn money irrespective. Not as much money in good times as just being long the market, but we won't lose money in tough times. In general, our business kind of has now got the diversification that makes us, or that
resilient,
enables us. It's much
irrespective
more resilient.
of market dynamics.
Much more resilient.
Now let's talk about offshore. Stenham, you own 85%
Yes.
of Stenham at the moment. 40% of your business, of the Peregrine Group, is firmly in the offshore base. Now, how quickly has that ramped up?
It's ramped up on a slower basis than I mentioned on the annuity side. But what's happened, I mean, one of the reasons it ramps up is because you have a weak rand, and even if your earnings are flat,
In pounds or in
dollars, they're worth so much more in rands. But there are another few reasons that I need to point out. An average South African today, institutionally or in his private capacity, trades a portion of his money offshore. That's been the way. You can get a lot more of your money offshore. People want to buy Facebook, they want to buy Apple, and funds. You almost don't find a fund today that isn't at its maximum level offshore. If you can
And
have
of course,
25%.
right now with the rand weakness, everybody is worried about what is happening to their wealth in developed market currencies. So in the pound, in the dollar, what exactly is your end wealth? Are you ever going to be able to go overseas again?
I must say, I think December was a period of time where most, even wealthy South Africans, wondered what could happen through the whole Nene saga, etc.
But it's not over yet, there. Jonathan. I mean, if you look at it right now, we're in a phase where we don't know who's going to run Johannesburg.
Yes.
We don't know who's going to run Tshwane. These are our key metros within the South African context, and we kind of between a rock and a hard place right now.
No,
so the pressure,
true.
where I'm going with this is that the pressure on the currency in terms of its performance against developed world currencies could still be significant. We could still see a weaker rand. Do you agree with me?
Yes, I think over time we're going to see a significantly weaker rand than we're seeing today. It still staggers me that you wake up in the morning and the rand's 13.20 and you have
go to
two
bed
meetings and it's
it's
13.60. I mean, these are big moves, and these moves are the order of the day. We've also noticed in our wealth management Citadel business that people are probably more keen on taking money offshore now than they were at any other time.
And of course it's panic.
There's
an
panic,
element of panic that is coming through.
and they feel there's a bit of a reprieve in the low 13s from the 17s that they might have seen in December, and now they're saying, hang on, this is our one chance to do this. Also, there's another event that's important, is global markets, particularly in the US, have performed well. So it's no longer a basis of, well, I'll, at least if I'm in South Africa, I'll outperform in rand terms by an order. You know what I mean? That nowadays you can put your money offshore, and in dollars, some of the returns that you're getting from overseas markets are looking like reasonable numbers.
And when it comes back to the currency, the real risk is, of course, that the Fed ultimately does raise interest rates because that economy is starting to fire on all cylinders. And we do see that flood of money leaving emerging markets, and that, again, exerting pressure, downside pressure on the local unit.
And you're ignoring any political event that happens with a finance minister, or more likely, people speak about an inevitable ultimate downgrade. No growth.
December is looming.
And even if it's not December, you have no growth, you have bad unemployment. Eventually it might well come, and people think that it will come. So But more than that, remember we have a, whatever, 6% inflation and they have a 1% inflation. Over time, we're going to see a weakening in our currency just based on the inflation differential. So there's certainly a view of people to get more of their money offshore. Kind of 50% it would be what most people with spare money.
50% of their money offshore. I mean,
That is what most people are looking.
significant.
That is significant, and that is kind of the benchmark for people. I'm talking your spare money, your investable money. You won't have necessarily 50% of your assets offshore. You still own a house or a car or whatever the case may be. But certainly there's a bigger move to that type of number than we've seen at other times.
If 40% of Peregrine Group right now is offshore, what for you is the perfect mix, given the current landscape?
So we'd like half of our business directly to be from offshore. So those are profits from subsidiaries that are based offshore. We'd like that to be half. Indirectly,
You're nearly there.
We're almost there. Indirectly, we think that number will be closer to 2/3. So I'll give you an example. You manage someone's money in South Africa in rands. You put a large portion of his money offshore. That money in rands does very well. You're earning rands on the money, but really the driver of that is his offshore exposure. So on an indirect basis, we think as much as 2/3. And it's happening organically. Our big brokerage business, clients are trading more offshore. It won't be long before we have an offshore subsidiary there. Our Java Capital Advisory business, there's a lot of work where we inwardly list property businesses, names that are common in that sector. We're doing a lot of work offshore on those names. Of course,
does it make sense to maintain just the JSE listing then?
We are not a business that has had to go to the market to look for capital. Remember, we're capital light. So to merely have a listing offshore for kind of the positioning rather than for raising capital is not something that we do. If we do
and also a costly exercise.
It is costly. I'm not sure it's been to the benefit of other financial services firms who have gone that route. For us, I think when it would make sense is if we did a very large acquisition and our business became very much bigger than the 6.5 billion that it sits at today. Then we've had a lot of foreign shareholders who I think might prefer to be on a London exchange, for example. Having said that, our shareholder base these days is up around 25% foreign.
A split between US and UK or predominantly UK?
Predominantly UK, but our largest foreign shareholder is based in the mighty land of Salt Lake City, Utah, mind you, the mighty city. So they come from different places, not the church.
Thanks for that clarification. What about where you live ultimately, given the nature and the shift of your business? Am I correct in picking up an element that if you are 50-50, it means you might relocate?
It's definitely a possibility. As the businesses grow there and as we create offshore subsidiaries of the local businesses, it becomes probably better to be closer to the new businesses to grow them.
Do you want to go and live overseas?
You can never live a better life than you do in South Africa if you're doing well here. But I would imagine that if the opportunity came, particularly for a period of time, we would consider it. But I can imagine having quite a difficult conversation with my wife, who runs a pretty big
and
medical practice.
And she's not being
here.
affected, she runs a medical practice.
Yeah, she's a
So
doctor.
it's more than just a discussion around the underlying environment and the economic
and the
environment
kids and all
the
of
political
those.
environment.
Absolutely, it is.
Where do you want to be 5 years out? Is there anybody that you are gunning for that position in the asset management space? You look at the glory boys of
Yes.
perhaps years gone by, the Coro, Alan Gray, etc., etc. Do you see yourself as one of the number one players?
We won't participate in businesses. Sounds like a throwaway line. We don't participate in businesses where we don't think we can be really dominant. So when we went into asset management, we could have gone into traditional asset management like Gray and Cora, and we said, no, we're going to hedge and we'll be the dominant or among the dominant players in that business, and so we built it. When we went into wealth management, we said we're not going to deal as a private bank dealing on the liability side. We're going to be an independent wealth management business, and we built
in Citadel.
In Citadel, and we built
so you've chosen your niches.
We've chosen our niches, and sometimes our niches we choose are not such sexy niches, but we feel that we can be dominant in that niche, and its time will come. So interestingly, when we built our stockbroking business, really in 2001,
this is the prime stockbroking business.
This is Peregrine Equities. When we built that business, which today, as I said, is the second largest business on the JSE and doesn't have an analyst in the entire business.
Technology based.
Entirely technology based. And looks after the hedge funds and works on the algorithms. And at our friends in the JSE, we're one of the huge players in co-location, meaning we do the trades on site. You know, when we built that, we built it because we said, could we build a business with all these analysts and compete with the big internationals who have access to huge research? No. But we do think that some of the market will go technology. Some of the market will want direct market access, trading directly, etc. And so we built what today is the preeminent business in that space. But interestingly enough, the whole market moved that way.
Exactly. So everyone adopted what you were deploying.
We went that way out of necessity because we thought we wouldn't be able to compete the other way. We wouldn't be able to compete with the Deutsches and the Merrills and etc., etc. But as it happened, the whole world didn't really love the research that much anymore and moved towards technology-driven broking, moved towards cost-sensitive, etc., etc.
So it was a differentiator, but now it's a common platform across all players.
Absolutely. But because we were there first, because we closed the clients early, because we became so big, so our costs reduced in that space, we could become the low-cost player in that space and quite a dominant player in that space. And nowadays, everyone who's left the banks again and set up their own little private client business come to us to execute the trades for them, if that makes sense for you. So we're the back-end platform for so many different players. So when you say, do we see ourselves as a Gray? The answer is no, we don't. Do we see us running 100 billion of private client money? Do we see our stockbroking business growing with the volumes that have happened, with a huge offshore element to it to counter for our local clients' offshore demands? Do we see a Java Capital continuing to dominate their spaces and, in the inward listing space and in the property space and in 10 other spaces as the world changes? We certainly see that happening. Where we are looking quite closely, though, is we always look for distribution opportunities. Every client we get has been hard won. We've had to go out there. We don't have access to their bank accounts. We don't have access to the lazy money. This is hard won. And there are some very, very interesting opportunities both here and abroad.
In terms of making acquisitions in this space.
Making acquisitions, merging, etc., and creating a business
a powerful distribution
very
platform.
Powerful distribution. Pretty much the last of the independents out there, looking after clients, not allied to one particular bank or one particular insurer. It certainly, we think, has been a competitive advantage to date.
Just one more question is about the entrepreneurial culture, and you've already elaborated on the fact that most of your staff have invested in your businesses. They are shareholders in your businesses. So that's obviously got to be one element that drives an entrepreneurial culture, because everybody is ultimately responsible for the growth that they derive from businesses, and they benefit from it.
Sure.
What else is essential when you want to create that entrepreneurial culture?
It happens by itself. People don't join us unless they believe they can run their own business and be successful at it. If you join one of the big players out there, you kind of view that your leads will come through the door, your revenue will come through the door, etc. How do you leave a big financial services business or a big professional services business and join a business like ours where you get incredibly well looked after and incredibly well paid, but the numbers are the numbers? You need to show the numbers every year and you get rewarded on that basis. These are people who have a drive, They would perhaps go and create, rent a house somewhere and start their own business, but that's tough in the regulation and the world that we live in financial services. So can they come in, be 50-50 or 75-25 partners with us, allow us to put the capital that's required in their business, but give them total free rein to run their businesses and be successful? That's the Peregrine story. And it's been successful for so many people throughout the years, and I think it continues to be so. So we attract those people. And when you have success stories, which we've had in several of our businesses, along with a couple of failures, undeniably, but when we have those kind of success stories, people love that story. They want to become part of us. They want to be partners with us. And provided you treat them fairly, and in terms of your contracts, and you don't have these committees. Our remuneration committees take 3 minutes because everyone knows what their situation is. That's a wonderful environment for people that are entrepreneurial in their hearts to join, and we never have a problem finding them, to be honest.
Jonathan, it's been great chatting to you. Thank you so much. Jonathan Hertz is CEO of the Peregrine Group. You're watching Captains of Industry here on CNBC Africa.